Great. Hi, everyone. We're excited to be here today, and what an incredible venue to have a conversation, especially after the election. So we're excited. I'm excited to kick off this panel. We're going to cover a few different topics. We'll start with some questions, just one or two, about the election. How should institutional investors think about that, and what does that mean in sort of the arc of institutionalization of digital assets? Then we're going to spend most of the time talking about 2025 and what themes this incredible panel of experts is excited about for the year ahead. So let me just start with kind of the first question, and then I'll ask you all to introduce yourselves in the context of your thoughts regarding the first question. But I think one of the things to me that's been really striking about the last 2-3 years has been, despite a really tough regulatory environment, a tough law enforcement environment, the institutionalization of this space has accelerated. And I don't know that I would have expected that, but we have seen that in a number of different aspects through ETFs. We have Larry Fink talking about tokenization, like, in his sleep probably. What do you think? How should institutional investors? How do you guys think about this election in the context of sort of this broader trend of institutionalization of digital assets?
Sure. I'll go first. Matt Hougan, CIO of Bitwise Asset Management. We're a $10 billion crypto asset manager serving institutions and family offices and advisors. I like what Alliance Bernstein said after the election, which is crypto won the election, buy with two fists. I think that's how you should see. Your framing was right. Crypto made a lot of progress over the last 4 years, despite massive headwinds. We got robust futures volume, we got futures funds, we got ETFs, we saw significant onboarding. And that shows you that bad regulation can slow an industry but can't necessarily stop it. I think now you have to completely reverse that and turn that tailwind into a headwind. And I think institutions should expect this to evolve much faster than maybe they were underwriting, even 3 months ago.
Happy to go next. My name is Tushar. I'm co-founder and managing partner at a firm called Multicoin Capital. We're a actively managed crypto fund with about $4 billion under management. And then for your question on the regulatory environment and facing that through the last few years, I've always had the belief that in a democracy, it is impossible for the government to ban something that the people want, even if the elites don't like it. And you can see this with crypto, where you had Elizabeth Warren's anti-crypto army, and it turns out there's no anti-crypto constituency. There's no anti-crypto donors, there's no anti-crypto voters, but there is a ton of people on the other side, us included, who are very active to try and make political change. And I think we're reaping the fruits of that now. So I think the institutionalization will continue. I think there's a lot of people who are waiting for that green light. And I think that as soon as they see that regulatory clarity come in, either through the appointment of an SEC chair who's not regulation by enforcement and gives us some sort of safe harbor. I personally really like Hester Peirce's safe harbor proposal that she put forward earlier. Hopefully they adopt that. I think that's enough. I don't even think we need to wait for legislative clarity. I think that safe harbor gives all these companies the green light to go and move forward. So that's what I'm keeping an eye on, is who do they nominate for SEC chair, and then what safe harbor proposal happens.
Great, Anthony.
Great tee-ups. My name is Anthony Bassili. I lead our asset allocators business at Coinbase, and also lead our tokenization strategy as well for Coinbase Institutional. Coinbase needs no introduction, but it is important to kind of introduce the idea that we serve both consumers and institutional customers, and those institutional customers day by day are growing. So they're hedge funds, they're venture funds, they're asset managers, of which all the large asset managers who have launched ETFs. We have over 90% of the Bitcoin in custody at Coinbase for those providers. It's perpetuals offshore, it's staking infrastructure, and the list goes on to technology around wallet infrastructure and more. So we continue to see inbounds and demand from institutions that we did during the bear market. regardless and in spite of the challenges we had from a policy perspective here in the United States, there was a lot of leading indicators to continue to push institutions into the space, one, because the market demanded it. Users still were buying crypto in spite of the volatility and everything else. You also had legislation going on around the world through MiCA and FCA and other jurisdictions that was very instructive to those in the United States, especially in 22 and 23 when we were sitting here going, why is it so bleak in the United States, yet we're seeing other jurisdictions move forward. And these were instructive for all of us in the United States to say, institutions are here, they keep building, they're going to continue to enter this space and use the technology. So we're in a completely different paradigm today. I don't think anybody expected to have as good of an outcome as we have from this election cycle. So it's, from my perspective, the most positive, maybe I'll even use the word bullish, setup that we could possibly have asked for, and I think it's surprised everybody. So we're very excited about what's to come next.
Great answers so far. It's hard to follow all of that with actually some additional information, but I will try. My name is Jennie Levin. I am the Chief Regulatory and Strategy Officer at a company called Figment. We are a staking as a service provider, so we run nodes on proof of stake networks to support the network and enhance security. I think that we saw initial involvement or tangential involvement from institutions, then FTX happened. I think institutions after that also shied away, not just for regulatory reasons, but I think that a lot of institutions and institutional investors are subject to regulations and their reputation is important. And their bread and butter business was not and is not crypto necessarily. And so they are not going to necessarily put themselves out there with the risk of putting their main business in jeopardy. So how is that changing now? Well, as we get regulatory clarity, whether it's through legislation where we see repealing of SAB 121, or we see a combination of FIT 21 and the market structure bill, or we see a new SEC chair and a new CFTC chair that are going to cooperate. We are going to see more institutions that become comfortable participating more variedly and widely in the space, right? We've seen institutions like Coinbase and others, they're building up their infrastructure. They're getting ready, right? They're custodying digital assets. So we do see that. But I think we are going to see, from Figment's perspective, we'd like to see that go further. We'd like to see institutions participate in protocol staking. They're custodying their assets. Let those assets work for the people who are custodying them with you. So again, as we see things change, we're going to see a shift, and it depends what institutions we're talking about, right? Are we talking about banks? Well, if we can get SAB 121 to be repealed and banks don't have to list crypto assets on their balance sheet, then perhaps we can custody at banks and use it as collateral and for lending purposes. The sky is the limit. And as far as institutions, like I said, I hope we see more institutions get in the custody game, into the staking game. And there are a lot of cool opportunities that we're going to talk about coming up in 2025 in the crypto world that are a little bit further down the line from a risk perspective. So hopefully institutions, and I think they will be more comfortable emerging in this space this year.
Great. Yeah, thank you, everyone. I mean, I think so let's go straight ahead and talking about kind of themes and what we're sort of excited about for 2025. And I mean, I really feel like, and just building on some of your comments, I mean, we're entering into potentially like the golden era of digital assets, right? Where the entirely new industry is being, will have rapid evolution during the next 4 years. And I think now, there are probably things that we're with a little bit more freedom to kind of experiment and kind of, with the full potential of what blockchain technology can do. So let me ask you guys kind of what like topics, themes, developments, new ideas, crazy ideas are you kind of interested in? And then maybe you can each provide some general reactions, then we can drill down into some of them. And let's start with, whoever.
Sure. So ladies first, right? So I think we're going to see a lot of movement in restaking, and that's going to be things like eigenlayer on Ethereum, and it's where you stake your Ethereum on the underlying protocol. So you engage in protocol staking, and then you can use those assets as part of the eigenlayer protocol, and they call it restaking. And so it allows you to earn higher returns on your staked assets. We're going to be seeing restaking for Solana, which I think is going to be huge. We're also seeing Bitcoin staking, which is a bit of a misnomer because it's really not staking your Bitcoin, but we have things like Babylon and Lombard and Stacks. And so you can use your Bitcoin and you can essentially lock it up, and then you can earn rewards and returns in other native tokens. Or you can stake a Stacks token, for example, and you can receive Bitcoin back for locking up your Stacks token. So, from a staking perspective, I think we are going to see people who, again, nobody wants their money to sit idle, right? They want it to work for them. And a way to do that, at least from a staking perspective, which is what I know, I know that you guys have a wealth of knowledge outside of that, but from a staking perspective, I think that we are going to see big movements in doubling your returns. I also hope to see, and Matt, I know you're the expert in ETFs and ETPs, but one of the things that Figment is really pushing is to have staking be part of ETFs. I think we are making some progress there, and I know Figment is working with Bitwise and Coinbase. But if we can get that, if we can have staking become part of ETFs and allow people to realize the full potential of owning Ethereum, I think that is going to blow up, and I think that institutional investors are going to really become more involved, and we'll see the Ethereum ETFs. Granted, market cap is not as big as Bitcoin, but we'll see it move up from where it is now.
Yeah, I guess I'll add to that too. So staking for institutions is going to be, it's going to allow institutions to deliver the experience of being a part of keeping a network secure and generate yield for investors. And so there's versions of this where you go really, when you're talking about Babylon and Stacks and others, these are new companies that are building products on blockchains that are going to allow market participants to be a part of the security architecture. They will also kind of help the market structure of crypto scale. And when you boil a lot of this stuff down, you're talking about market structure that's going to power the internet of money. And so again, this is about payments, it's about gaming, it's about staking infrastructures for yield generation and decentralization. And today there's $100 billion in DeFi. That was, I think at the bottom, it was still 35 billion or so in 22, 23. And so there's $100 billion in DeFi today. That's a product category. And so there's going to be a constant inbound of new fintechs and new companies that are coming in to build their web application that's going to utilize these decentralized and open source protocols. They're going to need custody services. They're going to need staking services. They're going to need people that run venture funds that are investing in those very early stage primitives to continue to grow this space. So I think from a trend perspective, you can kind of go all the way across the spectrum to go, what does the basic consumer need? They need access via ETFs, right? Something very simple. Within that, can you give them a total return product through staking yields? If so, great. Let's take it to the next step. Can you get an index basket to those consumers? If what's in that index basket? So we launched the Coinbase 50 recently, and so that's a top 50 by market cap index basket that's available for consumers outside the United States today, but eventually that'll grow and expand for other people to license that. And so I think this, the institutional conversation here is, it's about asset allocation frameworks. It's about institutions building new companies. It's also about serving consumers and new companies being built on the blockchain to utilize this tech. We're really excited about it.
Look, I think sometimes these panels can be a little boring if everyone just agrees with each other, so I'm going to disagree on a couple of things that you said, and then I'll talk about what I'm excited about. Huh?
Him? Are you going to disagree with or me?
I disagree with you.
Oh,
actually.
okay.
There we go.
Yeah.
I need to pay attention now.
So the first thing I disagree with is I don't think Bitcoin is supposed to work for you. I think the point of Bitcoin is it's hard money, not to be earning some yield on it. And I think lending out your Bitcoin or putting it into what's basically a multi-sig is extraordinarily risky. And I would hope that we learned our lessons from the Celsiuses and BlockFis and stuff of last cycle. people don't want to borrow Bitcoin, right? Like at the end of the day, interest comes from people want to borrow the asset, and people don't want to borrow Bitcoin because when you borrow Bitcoin, you have to pay back more Bitcoin later, and there's just no natural borrowing demand for Bitcoin, or if there is, it's infinitesimal. So I'm pretty skeptical of the Bitcoin staking yield earning opportunities, and personally, like, I would not participate in any, just because, like, I think that's against the point of Bitcoin. I'm also pretty concerned about restaking, whether on Ethereum, Solana, elsewhere. Just it reminds me of rehypothecation in TradFi, and just like that interwoven web of risk that then becomes impossible to untangle. And I think that there are weird externalities that can happen with restaking. If, for example, like how many times can you restake the same asset? And then how much security is it contributing to the nth restaked thing is, I think, a open question, which we will see empirically. Like, people are not going to listen to me. They're going to do the restaking thing, and then we'll see it blow up at some point. So that's my spicy disagreement. And I will add very briefly what I am excited about. The thing I'm most excited about is cash flows going to token holders. I think we're going to start seeing that happen now that we have potentially a much more friendly SEC with safe harbors. And I think cash flows going to token holders will lead to a resurgence in actually useful crypto stuff and less, not useful infrastructure or not useful meme coins. And I think it's going to be the resurgence of things like DePIN and DeFi. I think we'll do very well if they're able to actually talk about how they're delivering cash flow to token holders.
Jennie, do you have a rebuttal? Are you?
Yes, I mean, I think that you make some valid points. I think there are going to be regulatory hurdles to restaking beyond just that. It's not protocol staking, right? So there are going to be regulatory hurdles, but we're already seeing a ton of interest when it comes to participating in EigenLayer. And so I think that the market is speaking that, like you said, they're not going to listen to you, and it might blow up on them, right? But I think that as we get more sophisticated and as the players that are participating in it become more sophisticated and have backgrounds in this field, the risk decreases. I also think that when we talk about stacks, we're not talking about locking up your Bitcoin and lending it, right? We're talking about actually receiving Bitcoin back. You're staking stacks, and then you're getting Bitcoin back for locking up your stacks tokens. And so it's actually, who doesn't want to get more Bitcoin, especially because Bitcoin is, what's it, 94,000 plus yesterday, and we're going to talk about having Bitcoin reserves. So any way for people to participate in getting more Bitcoin, I would think that the market's going to jump at. But again, I'm not the market, so I think you make valid points. But I think from a staking perspective, which is what I know because I'm immersed in it, and so we talk to institutions and institutional investors who want to participate in this field, and I will tell you that there's a lot of interest. There's a lot to learn. It's complicated, and we have to methodically work through that because, again, institutional investors care, and they're going to do their due diligence and be responsible. But I think that this is going to be an area that we should watch and institutional investors should watch. And then it depends on your risk profile.
Yeah, I think I can split the difference on Bitcoin staking and then add my own thoughts. I think you're both kind of right. Look, we get calls every day from institutions who want to earn yield on their Bitcoin, but it's a fraction of the people. But the scale is so large, right? A third of ETH is staked, so whatever, it's 120 billion. If 4 or 5% of Bitcoin is staked, it's roughly the same size. Do I think 5% of Bitcoin holders are willing to risk some technical risk in order to earn a yield? I don't know if it's 5, but it might be 3 or it might be 2, and that's still a pretty large number. And I do think that's going to happen in the Bitcoin staking space. The things I'm excited about to stay in my ETF lane, I think there are probably 3 things that people are underestimating on ETFs by a significant fraction. One is that the demand we've seen is just a down payment. Like, it's a tiny fraction. $30 billion, I think, is nothing for what we're going to see next year. The Bitcoin ETFs are only about 20% owned by institutions. I think that'll be 40% within the next year or two. And I think next year we'll see 50 billion plus inflows. I really think we're just getting started. We're not even approved on major wirehouse platforms. That's going to shift almost instantly. The other thing I'd add on that point is we survey institutional investors and family offices every year and ask them why they're not allocating to Bitcoin. For the past 6 years, it hasn't been volatility, it hasn't been like the boil of the oceans or criminal activity. The number one thing by a huge factor has been regulatory concerns. And so that's been removed. And so I really think people are going to be surprised to the upside on next year flows. The next thing that I still think people are under anticipating is that the ETF industrial complex is like insatiable. And it's looking at the Bitcoin market. These are the fastest growing ETFs of all time. MicroStrategy is the most traded stock of all time. You're going to see a spaghetti of good and bad ETF ideas and every asset trying to get its own ETF. There's just going to be like infinite revs, and you're going to have to be picking and choosing. And then the third thing, back to the staking comment, you're going to see the ETFs get better. So in-kind creations, redemptions, staking on ETH, all of those conversations are going to take place next year. They were already going to take place regardless what happens. To put you in the room, you talk to the SEC about in-kind creations and redemptions, and they tell you, we can have that discussion if you want, but you can't launch with everyone else. That's why no one pursued it. And now that they're out, everyone is going to pursue it, and there's no real reason we shouldn't have it, and I suspect we will. So better ETFs, a lot more ETFs, and then flows that surprise on the upside are what I'm excited about within the ETF space.
Great. We've got about 4 minutes left. I want to see if we can get in a couple more topics. So one thing we have not talked about yet is, just digging a little bit deeper in the DeFi space and on-chain asset management. I know that's something, Anthony, we talked about for a bit. I don't know what are your thoughts on that space and what is Coinbase doing there?
Well, so I think what we've seen, the base case for most digital assets is that you have open public rails that anyone can access through a wallet with internet connection. So the idea here is that anyone around the world should be able to access, should be able to send money back and forth from themselves to their peers, just like they send data. It should move instantaneously and settle instantaneously. And so that's live today. And so you're serving that customer directly in their wallet with this new primitive of sending money instantly, which didn't really exist before that in its current form. The second thing is, like, how do you start to serve them in a more holistic way with other financial services? So, if you're in your wallet and you can stake while you're holding your assets, or you're generating yields directly in your wallet, this is a really novel new concept of having your assets in your own person, and now it's doing what it used to do inside of a centralized institution. So we're excited about that. And then again, this is kind of going into the DeFi conversation around if you're able to then get access to advisory, optimized portfolios, these better constructed assets and strategies in your wallet, again, that's a really big primitive. And so I think what you're going to continue to see is a build out of products and services within major institutions like Coinbase and Bitwise and others. But you're also going to see a lot of the asset management community really go on chain and stake their claim. And they're going to say, there's a whole new market of participants that are going to come out of everywhere globally, and they're going to have access to financial services, and we have to figure out what distribution looks like in that space. That is not defined. And so it's a completely wide open space, and I think that's going to be a really interesting space to watch over the coming cycle.
Yeah, I would just add, I agree. I think it's going to go much faster than people think. It's been slowed down substantially for two reasons that just changed. One is that developers were afraid of being put in jail, and so that kept people out of the market. And then what Tushar said, there was no guarantee for how to accrue fees to these apps or strategies or protocols, and that's probably going to change too. So that's like a compounding effect, not twice as fast, but like 8 times or 10 times as fast.
Related to that trend, what do you guys think about the tokenization of real-world assets, traditional assets? We've seen a lot of T-bills come on chain. We're seeing people bring other sovereign debt on chain. Like, what's next? What's primed for tokenization next from sort of the real world?
I can take a first stab at it. Look, I think you're going to see the tokenized T-bills or interest-bearing stablecoins be the immediate large thing. That's not controversial. There's lots of people around the world who want interest-bearing dollars who can't get them, and now we have the rails to give it to them. Personally, I am more excited about crypto-native assets than I am about bringing real-world assets on chain. I think bringing those real-world assets, tokenizing equities, real estate, et cetera, can improve the market structure of those things, because now you can have smart contracts on that are accessible to everyone on how they want to trade things. You can see AMMs and other types of contracts. So I think that's useful. But what I'm most interested in is using crypto rails as a means of coordinating real world capital formation, things specifically like DePIN, right? Like, let's build a wireless telecom network using crypto rails. And to me, that's a real world asset, but it's a crypto native real world asset that wouldn't have existed without crypto. It's not a, like, let's take this thing and put it on rails, right? Take this thing and put it on rails works, right? Like when the internet came around, like yellowpages.com was a big deal, right? But then the crypto native thing was Google, and that turned out to be a way bigger deal than just taking the old thing and putting on the new paradigm.
Yeah, great. Anyone else have anything else on?
Yeah, I think you've got a couple flavors. The biggest challenge that real-world assets and tokenization has today is it's all actually just legal market structure. So if the legislative bodies say that you can represent ownership in a token format of a security, and then we can then issue that security digitally native to where it's not like a DTCC thing that also has a copy of it, then the product is actually really great. But the supervisory authorities and regulatory bodies out there have to be able to observe securities. They have to be able to have control over KYC. All those things have to be compliant. They don't yet know how to observe the stuff on chain. They don't know how to control it, stop it, et cetera. So I think you're going to continue to see capital formation with people who are raising money to fund things, and it is an efficient tool for that. It'll be this mirror image of I own exposure to some real world thing that isn't necessarily actually on chain. Which is fine, the internet does that too. We'll probably be in that space in this cycle, and then over the course of the next 2 or 3 years, you're gonna see in Congress and the House, you're gonna see a lot of bills that are gonna start to introduce what does a clearing body, what's their job today in terms of monitoring and managing money flows across this ecosystem for securities. If you're a CSD in Europe, you're asking the same question, like what's your job as a clearer, because clearing isn't necessarily a thing anymore on chains. So you won't see robust secondary markets for securities on chain. I don't think this cycle. That's probably next cycle thing.
Awesome, great. Well, we're at time. Thank you guys. Appreciate it. Please join me in giving a round of applause.